Welcome to Financial Beacon Consulting. Today we are looking at what auditors normally look for when reviewing a business. Many people fear audits because they imagine auditors are only looking for mistakes. In reality, auditors look for evidence, consistency, and whether the business has followed the right procedures. If your records are organized, your documents are available, and your figures can be explained, the audit process becomes much easier. The first thing auditors look for is clean and complete records. They want to understand how the business records sales, expenses, customers, suppliers, and monthly activity. If the books are scattered, incomplete, or only updated at year-end, the auditor will ask more questions. Good records show that the business is being managed seriously and that the financial statements are built from real activity. Auditors do not only look at totals. They ask what supports those totals. For sales, they may check invoices, receipts, contracts, delivery notes, and payment confirmations. For expenses, they may ask for supplier invoices, receipts, statements, and proof that the expense relates to the business. The simple rule is this: if a figure appears in your books, there should be a document that explains it. Another key area is bank and cash reconciliation. Auditors compare your accounting records with bank statements, cash books, mobile money statements, and payment records. They want to know whether sales were banked, whether expenses were paid properly, and whether customer balances are accurate. If the bank balance does not agree with the books, the difference must be explained clearly. Tax compliance is also important. Auditors check whether tax returns agree with the business records. They may review VAT, income tax, PAYE, withholding tax, and electronic tax invoices depending on the business. If income in the books is different from what was declared, or expenses are claimed without support, that creates audit risk. Filing returns is good, but filing returns that agree with records is even better. Auditors also look at internal controls. Controls are the simple rules and checks that protect the business. For example, who approves payments, who records transactions, who receives money, and who reviews reports. When one person does everything without review, errors or misuse can go unnoticed. Good controls do not have to be complicated. They only need to show that the business has a reliable process. There are common red flags that can make auditors ask more questions. Missing receipts, large unexplained withdrawals, mixing personal and business money, unsupported expenses, late filing, or figures that change without explanation can all raise concern. These issues do not always mean fraud, but they create doubt. The best protection is to keep records updated and explain unusual transactions early. The best advice from Financial Beacon Consulting is to prepare before anyone asks. Update your books monthly, keep digital copies of documents, reconcile bank and cash accounts, review tax compliance, and separate personal transactions from business transactions. Audit readiness is not a one-day activity. It is a habit. For help with bookkeeping, tax compliance, QuickBooks, and audit preparation, contact Financial Beacon Consulting. Like, comment, follow, and share for more practical business finance tips.